One of the most basic mistakes in investing is caused by the psychological phenomenon called availability heuristic. This applies not only to investing but also to trading. Although my channel is definitely not about trading, I generally don't like trading. I can't really imagine how someone can seriously enjoy living like that when you are looking endlessly at your portfolio, monitoring the news, the graphs all the time, every statistics, every report, whether something was approved or not approved. I think that it is an unhealthy way to live. So the availability heuristic is a psychological mechanism. The point is that people make judgments based on how easy or accessible it is for them to recall or present certain information. For example, people judge the prevalence of a certain disease based on how often they hear about it and how many people they know have it. Long story short, people overestimate the events of which they hear too much about and underestimate the events of which they hear too little about. In everyday life, this mechanism is useful. The brain developed it in the process of evolution, as in certain situations it can be an effective and quick way of making decisions, which is essential for survival in dangerous environmental conditions. But this mechanism also significantly distorts our perception of reality, leading to wrong expectations and wrong conclusions. Perhaps my two favorite questions are: what percentage of people in the world do you think are billionaires? And what percentage of people live in extreme poverty? When you ask people these questions, it feels like 2/3 of people are living in extreme poverty and another third are billionaires. In reality, there are only a few thousand billionaires around the world, while the world's population is over 8 billion people. So it is actually a very small percentage. And people living in extreme poverty are only 8% of the world's population, not 40, 50, 60 as many people think. The YouGov poll shows it very well. People overestimate the percentage of minorities in the general population, and for the same reason people underestimate the size of majority groups. People give the most accurate estimates of the size of groups that make up about half of the population. So how can this phenomenon makes us make mistakes in investing? First of all, it is a distorted understanding of the situation. As a generation that grew up during the rapid development of computers, the internet, smartphones, and other technologies, we can expect that such a rapid development of technologies will continue in the future, and in 2077 there will be cyberpunk. However, this is not at all guaranteed that there will be any significant technological advance. Technology development is unpredictable, and there is a chance that it will slow down in the future rather than accelerate. For example, the development of computer components has already slowed down. 10 years ago, a new generations of CPUs and GPUs had a greater performance boost than they do now. That is, the performance growth of video cards and processors is slowing down. In addition to the misjudgment of long-term trends, there may also be an overestimation of recent events. People can be heavily obsessed with the recent events or market trends instead of carefully analyzing long-term fundamentals. We can often see how some stocks in the market lose inadequate percentage of their value due to a not a very big problem, and vice versa. Some minimally positive news triggers inadequate growth. A good example would be the rise of the so-called pandemic stocks in 2020. When everyone was at home in quarantines, people began to buy shares of companies that benefited from this. These stocks inflated ultimate bubbles. And then when life returned to normality, these stocks also returned to the pre-pandemic levels. Another problem is the opposite. People can ignore, miss, and underestimate the likelihood of the events that are little spoken about and that are not easily accessible in memory. For example, some people make the mistake of looking at history and seeing that the biggest drop in the S&P 500 index was 80% from its peak during the Great Depression. And then they think that's the biggest possible drop that can happen. But before the Great Depression, the S&P 500 has never fallen by 80%. Such thinking is an obvious mistake. Of course, an 80% drop in the S&P 500 seems impossible right now. Therefore, let's recall more recent examples. In March 2020, when oil price rapidly began to collapse due to the spread of the pandemic and the disruption of the OPEC cartel deal, people began to actively buy oil, thinking that it would definitely not fall below $10, then $5, then $3, then $1. As a result, oil prices reached negative values, triggered stop losses and margin calls, and people lost a huge amount of money. Wrong expectations, overestimation and underestimation of risks are not the only problems associated with the availability heuristic. Underestimating prevented events, or conversely overestimating unprevented events, is another aspect related to the availability heuristic that can influence investment and trading decisions. People only see what happened and ignore or downplay the prevented events. Of course, this is a more global question concerning not only investments. Who knows how many different catastrophes, terrorist attacks, tragedies are constantly prevented by small security measures for which no one will say thanks. Most people only say thank you to those who solve problems, not preventing them, although it is obvious that it would be better if there was no problem from the very beginning. It is probably one of the most underrated things in the world. In investing, people may not pay enough attention to successful decisions that help to avoid big losses in the market or avert a financial crisis. So basically this is another underestimation of risks, which is the result of not paying enough attention to solutions that prevent crises and losses. It also leads to a distorted perception of the past. If we look into the past, we see only what happened, not taking into account what could happen. Another problem is the tendency to draw conclusions from information that is more easily available or support the point of view, ignoring less available data and information that does not support the opinion. The conclusion from all this is quite boring and simple. You need to do a deeper analysis of the market and companies in order to make better investments. Wow, who could ever imagine such a thing? That's all. Next time we will talk about another psychological phenomenon that leads to investment mistakes, which is the tendency of people to see relationships and patterns where there are none.